everyone. This is Kathy. 1 second. Can you let me know if you can hear my voice, see my screen, make sure everything is working well? Let me know and we will get underway. I'm just checking all my settings here. I'm going to move myself and my screen. Okay. So good morning, everyone. Hello, Hawkeye. Hello, Miss Actor. Hello, Park. Good morning, everyone. There is so much to talk about this week. There's, certainly a lot on the calendar, and I want to welcome all of you to our Monday market outlook. And, this is one of the weeks that you definitely want to be on stream with us because we've got so much to share. Boris, do you want to come online and say hello? And, let's see if he's around. Well, as I said, there's so much to talk about this week. Hello, Boris.
Hi, guys. Hi, everybody. Can you hear me?
Yes, we can hear you.
Okay. I'm going to say hi, then I'm going to disappear because I don't want to take attention away from Kathy. She's got a lot of interesting stuff to say. And then when she's done, we're going to keep on going because we're going to trade all the way through the open today. I got a lot of cool stuff to show you, and we'll talk a little bit about macro as well. But I'm going to let her run the show at the beginning so you guys focus on all the stuff she's got to say. So I'll see you guys in about 15 to 20 minutes.
Yes, and that's absolutely right. There's no shortage of things that I'm going to be sharing with you this morning because when we have big events like this week, especially central bank events, what I love to do is I love to go and share with you the central bank trading calendars because I think when it comes to trying to figure out what the central bank will do, and I don't think that we've had a Federal Reserve meeting as close as this one, where it's basically 50-50 odds of whether we're going to get a 25 or 50 basis point interest rate hike. So we haven't had, a period as close as this. And when we have something that's so tight, we really need to try to figure out how to put ourselves into the shoes of the central bank. And this is extraordinarily important. So we're going to take a look at my central bank tables. That's going to be very, very valuable. But whenever we walk into a new trading week, the most important thing as traders to take into consideration is where are we coming from? What's the sentiment of the markets and where had we been in the past? So I'm going to go ahead and share with you my screen. So give me a second. Hello, Junix from Italy. Where are all of you coming in from? Are you European? Do I have my friends from Asia joining me this morning? Let me know if where are all of you coming from? Brazil. Someday I plan to make it to Brazil. All right. So right now you are looking at my heat map, which we will go over in just a few minutes. But what I really want to start by talking about is price action. Because when we start a new trading week, it is absolutely important to understand the sentiment in the markets. Now, if you have been through these sessions with me, you join us in our weekly live streams or attended any of my classes, I will share that I will share that the most important part of trading is making sure that you are on the side of the market. And being on the side of the market means having fundamentals, technicals, and sentiment on your side. So every single day when I start my trading day, I will look at where are fundamentals, where are technicals, where is sentiment. And that is the same thing that we do when we approach this new trading week. So right now you're looking at my charts, and the most important thing is, what is the market feeling? What is the market thinking? So if we look at the right-hand side in my watch list, you will see that first off, risk is on. Stock futures are up. And stock futures are doing really well. I mean, stocks are pretty much at their previous highs. And we've recovered extraordinarily from the July lows. So stocks are doing very, very well. And that tells us, at least from the stock market's perspective, that the market is not worried about the Federal Reserve being too conservative. They think that the Federal Reserve, which is the biggest event risk this week, is either going to be dovish, like they're either going to cut interest rates by 25 basis points and signal a strong intention to continue to lower interest rates, or the Federal Reserve will just come right out and lower by 50 basis points. The fact that stocks are close to these previous highs suggests to me the market is definitely leaning more towards a 50 versus a 25 basis point rate cut. Let's see what bonds are telling us. Bond yields have collapsed significantly. This is the lowest level that we have seen bond yields since June of 2023. And throughout last week, bond yields had hit fresh lows and just consolidated there. So bond yields have also moved further much faster than US bond yields have moved further much faster than, for example, German yields. German yields are also lower, but US yields are fallen, to fresh lows. And today, yields are mixed. They're up a little bit, which means that, the market, at least the bond market, which oftentimes will price things in much faster than the other markets, are, pretty much satisfied in how they're pricing in the rate cut. As they've already driven rate cut expectations quite lower. I don't think, tomorrow we have US retail sales. That's a very important report. I don't think that it's going to be adjusted all that much before FOMC. And we'll talk about what's expected for retail sales in just a second. What is gold telling us? Gold hit a fresh record high. Now, gold, of course, hit a fresh record high because, gold broke out, last week. I hope all of you do watch our YouTube videos, because at the beginning of September, the first week of September, I posted a video about how gold is going to break out this week, because on a seasonal basis, September tends to be very, very good for gold. And that is why I encourage you all to watch my latest video on YouTube, which I'll post later on. Maybe Boris can help me post that, on the 4 ways to trade the Federal Reserve rate decision, because, I outlined for you all of the different scenarios that, we could find trading opportunities on for the Federal Reserve rate decision. I just posted the link into YouTube. So make sure you watch that, because these things can help you prepare for what is most likely to happen. So gold is at a record high. And the fact that gold is at a record high tells us that the market thinks that the Federal Reserve is going, at least the gold market thinks that the Federal Reserve is going to make a bigger move. And then what is the US dollar telling us? Dollar yen dropped to a fresh July 2023 low overnight. So dollar yen, as you can see, has been on a consistent downtrend. The US dollar is lower across the board. You forex traders are bracing for either a big move by the Federal Reserve, or they're bracing for some very strong dovish language from the Federal Reserve. So I've got some questions coming in, and of course, I'll answer all of them later. But this is an important question from Hidden in Plain Sight about indices. And the question is, will we see weaker indices this week? Well, this is a good time to talk about what would drive stock indices lower. Now, the only thing that, first off, if US retail sales is terrible tomorrow, we could see a slide in US stocks, but a durable decline in US stocks would not occur unless we have the Federal Reserve doing 25 and then, sounding wishy-washy, still sounding optimistic on growth, still worried about inflation being sticky, and then also, not all that concerned about the labor market. If we get that happening, yes, stock futures could fall. If, however, we get really dovish Fed, then, we'll probably see stocks hit new highs. But after that, this is a really good question. It's not as if we're going to hit a new high after FOMC if we get a big move and it's just continue to power higher. More likely, it's going to hit a new high, maybe continue to trade higher for another day, and then, market's going to think that all of the big event risks are behind us. Let's just wait and see the following non-farm heroes report, because all the big data is already done. And then maybe stocks could actually correct into the first week of October. So the point I'm getting is that, yes, we could see, if we get the Fed is dovish, we could see a new push to new highs this week. But the next 2 weeks after, we may not have anything else to keep it up there. And so therefore, we could see profit taking. So I think that, and this is all ties into sentiment and positioning, because the market is already so positioned for a big move. Now, before we look at my central bank tables, let's take a look at one more thing, about regards to sentiment, which is the CME Fed Watch tool. And I love to look at this. We look at this all the time to get a sense of what is priced in. And this is basically whenever you read a news article saying 25 basis points is priced in, 50 basis points is priced in, this is what they're talking about. They are looking at this and they're saying, okay, now look at this. Guys, 65% chance of a 50 basis point rate cut. So first off, the way to look at this right now, current interest rates is at 5.25% to 5.5%, which is, you see the current target rate in the middle. Unfortunately, my mouse is not showing. But the first, here we go. The first huge bar is 65% chance of a 50 basis point rate cut. So the market is actually pricing in some ways, a higher percent chance of a 50 basis point rate cut than a 25, which is over here, 35% chance. This is a dramatic change from a month ago. A month ago, we're at 25% chance of a half point move and a 75% chance of a quarter point move. Yesterday, we were at 50-50, or Friday, we were 50-50. A week ago, we were only at 30% chance of a half point move. So it kind of explains to you how the dramatic shift in expectations that we've had from the Federal Reserve. So the next question is to ask is, does the economy warrant a 50 basis point rate cut? So this is a good time to turn to our central bank tables. So this, and I've done this, and I'm going to, give me 1 second, I'm going to reshare my screen. I'm going to stop the screen. I'm going to reshare my central bank table because for some reason it doesn't always share the way that I want it to share. I believe this is it. If not, we'll just flip around. Yes, that's it. Okay, so what you are looking at here is you are looking at my central bank table. And every single month, and that's why I told you it's so important to join me for this week, because this is the week where we have so many central bank meetings. We've had to put ourselves into the shoes of the central bank and look at, does the economy truly deserve 50 basis points or truly need 50 basis points of easing? Well, I invite you to answer that question. I mean, Boris, could you put up Boris actually stepped away. But we'll do a poll. Boris, can you do a poll on whether people think the Fed will cut interest rates by 50 or 25? And he's going to put up this poll. But at first glance, what do you think? Put some thoughts into the chat. I can tell you that just at first glance, there's just as many reds as there are greens. There's just as many greens as there are reds, meaning that there are just as many parts of the U.S. economy that is dollar bullish and has improved as there are parts of the economy that's deteriorated. I mean, look at this. Retail sales last month. Of course, we get tomorrow's report, which may change the outlook a little bit, but retail sales was actually up in August. Core retail sales was weaker, but retail sales overall was up. University of Michigan Consumer Sentiment Index was up from the last Fed meeting. The Conference Board Sentiment Index is up from the last Fed meeting. Non-farm payrolls, okay, that was not good. That did weaken. And the big problem and why everyone thinks maybe the Fed could do 50 instead of 25 is because the Fed told us, Powell told us at Jackson Hole that inflation has fallen enough for them to be confident that it's going to go back to their targets. Now they can focus on the labor market. But earnings are up. The CPI numbers from July, they weren't bad. This is the reason why mid last week, everyone dropped their expectations from 50 to 25, thinking that the Federal Reserve should do a smaller move because inflation is sticky. So consumer prices were up in July. Core consumer prices were up. Now, year-over-year CPI, which is the most important part, was actually down. So year-over-year CPI was down, which definitely is problematic. Producer prices were down, definitely added on Thursday to the expectations for a 50 versus 25 basis point rate cut. Housing market not doing great. Any of my Americans here know that, feel that, see that. Housing market is not doing great. The only thing that's really moving is maybe we have a little bit of more existing home sales, new home sales, because interest rates are lower, but builders are not building because they don't feel that there's going to be any type of recovery in the labor market. Then we get to the manufacturing and services indices. Manufacturing sector is contracting at a faster pace. Service sector actually, went from contraction to expansion. And, you all may know that the U.S. is a service-based economy. So services matter much more than manufacturing. So services isn't doing all that bad. Trade is doing kind of weak. Industrial production is kind of weak. Stocks are roaring. And bond yields, this is kind of important. Bond yields are down sharply. At the last Fed meeting, bond yields were at 4.2%. Now we are at 3.67%, which is basically a 50 basis point drop, right? So in many ways, you can argue that the bonds yield themselves have done the work for the Federal Reserve, because the Federal Reserve, when they cut interest rates, what they hope for is for bond yields to react, right? They hope for that bond yields will react, they will fall, and they will make borrowing costs in the U.S. lower for consumers and businesses. But borrowing costs have already fallen. They've already fallen 50 basis points, which is a really nice, chunky, generous move. So I ask the question again. Do you think that the U.S. economy needs a 50 basis point interest rate cut now? Now, I'll let you answer the poll before I give you my feeling. The reason why these odds have suddenly shifted to 65% chance, or the market pricing in a big rate move. The reason why that's happened is twofold. Number one, yes, on Thursday, we had weaker jobless claims data. We had weaker producer prices. So all of that, was definitely weaker. Market was not super enthused by that. But the main reason was with two main reasons. Number one, former Fed President Dudley, who is a respected person within the Federal Reserve, came out and said that, he thinks that 50 basis points, a bigger move is needed. Then Dow Jones reports that, it cited anonymous sources in the Fed, also think that 50 basis points is expected. Now, I want you to realize right now we are in the quiet period of the Federal Reserve, which means that no Federal Reserve president is allowed to no current Federal Reserve president is allowed to say anything to the press. So what's going on? Are they trying to drip things into the market through former Federal Reserve officials? Are these former Federal Reserve officials speaking on their own behalf? The one thing I can tell you is that the Federal Reserve and any central bank hates surprises. They do not like the worst thing that can happen for a central bank is they make a really big move. And this is the first interest rate cut since 2020. And we have a huge, massive spike in volatility in markets. Of course, us as traders would love that, right? Because obviously traders thrive on volatility. And that's where we get the greatest opportunity. But that's not what the central bank wants. In the best case scenario for the central bank is they make their move and nothing happens in the markets, because they want, to be able to help the economy without causing a major impact in the markets. So there is some belief that maybe the Federal Reserve may come in and through some form or another and signal to the market, either through some other drops in the press, through anonymous sources in the Fed, saying that maybe we will do 25 instead of 50. If they do not, and we hear nothing from the Federal Reserve until Wednesday, then the dollar will remain weak, and the odds for a 50 basis point rate cut could still be there. So now let's get back to what I think. So many of you have shared your views. Boris, can you close the poll and let me see what it is at? It looks like 65% of you expect a 25 basis point rate cut from the Federal Reserve. 25% expect 50 basis points, and 9% of you expect no easing at all. So this is what I see. The Fed has two choices. Now, I think you will all agree with me looking at this table. The US economy does not need 50 basis points of easing right now, because there's just as much green as there is red. There's just as much improvement as there's deterioration in the U.S. economy. I don't think it needs 50 basis points. And I think that, yes, the U.S. economy needs 50 basis points in the next, throughout more than 50 basis points in the remainder 4 months of the year, but not right now. I think that with stocks hovering at, it's at such high levels, it would serve the Fed better to save their ammunition, their firepower, for when stocks are down, 1,000 points, and they really need to come in with a big move to support the market, support confidence. So I think for them that it would be smarter to save a bigger psychological move of 50 basis points for a later period in time. Also, if you think about it, right, the election is coming, and for the Fed to come out with a 50 basis point move in September, it could be seen as controversial, and it would certainly be probably cited as controversial by the Republicans, saying that maybe they're trying to support the labor market, the stock market before the elections, and help to support a Democratic victory. And the Fed certainly doesn't want to appear to be in that position either. So for those reasons, I think that they're going to go with a smaller move. Now, that is important, of course. The big size of their interest rate cut is important. But something else is even more important than that. And that something else is the dot plot. Now, let's take a look at the dot plot. Federal Reserve dot plot. I'm just going on Google, and then I'm going to share with you my screen in just a second to show you exactly what I want to share. Hold on. Let me share my screen. I'm going to share with you my screen, and the dot plot is single-handedly the most important thing in what the Fed's going to show us this time around. And let's just skip forward. Here's a dot plot, okay? Lots of fancy dots. And I'm going to talk you through this. You don't really need to pay too much attention to this. But, okay, so this is an important Fed meeting because not only do we get the rate cut itself, but we also get the economic projections. They're probably going to lower the growth and inflation in projections, so that's expected to be dollar bearish. And then we get the dot plot. So for those of you that are not familiar with the dot plot, what the dot plot shows you, what the dot plot shows you is what these Federal Reserve officials think, where they think the Fed's funds rates will be in 2024, 2025, 2026. And I can tell you, and there's a lot of dots here. The most important thing for you to know is that in June, which is the last time the dot plot was released, the dots showed only two, where's my now fingers? 2 interest rate cuts this year. Right now, the market's pricing in 2 just for Wednesday, and pricing in 100 basis points for the rest of the year. So guess what needs to happen? These dot plot will change, or the market needs to see the dot plot change to what they are thinking. And so this is single-handedly the most important part of the Wednesday's FOMC statement, because first off, in June, it only showed 2 interest rate cuts for all of this year. So those dots will start to need to drop. They're going to drop, I don't think, to down somewhere over here, and that will drop. But how much will it drop? Where will these dots, where will the majority of the dots be at? Will it be at 3 or 4 this year? And will it be, or 5 this year? Or probably not 5. 5 is overly optimistic, but will probably be at 3 or 4 interest rate cuts this year. And then what is expected for 2025? Will the dots show mostly front-loaded easing, meaning more dots towards like 4% for this year and next? Or will it show like kind of spread out? Maybe 3 this year, maybe 3 or maybe 2 next year. Where do these Federal Reserve presidents think how rates will be, and how far and how quickly do they think it needs to be lowered? That is single-handedly the most important part of the Federal Reserve rate decision. And once again, I posted my video on how to trade the FOMC on Twitter. And in this, I talk about, which I just posted again, in this, I talk about how we have basically at 2 o'clock, we get the rate cut, the economic projections, and the dot plot. All three come at 2 o'clock. Then 30 minutes later is when we get the press conference from Fed chairman. So there's going to be a lot of volatility at 2 o'clock because probably in many ways, the most important part of the whole Fed decision is going to come at 2 o'clock this time. And then we wait 30 minutes and I talk through this video, how to trade during those 30 minutes. And then we get Powell speaking. Powell speaks and, we get the real takeaway from the Fed. So it's going to be a lot of volatility at 2, probably more than usual. And whereas last meeting, we didn't have the Fed projections, so we got nothing at 2. It was only 2:30 when he spoke that we really had some volatility. This time, it's going to be very, very different. And so this is the most important part of the Fed rate decision. So with that, now we go back to my Fed funds table. So with my Fed funds table, the question now is, where am I leaning? I am still dollar bearish. I think the outcome, dollar is going to be selling off going into the Federal Reserve rate decision. Dollar had a little bit of pop after this morning's Empire State Survey, but not much. But I think the dollar will remain under pressure into and after the Federal Reserve meeting. I talked about all the reasons why. We also have U.S. retail sales this week, which, auto sales was very weak. So I think U.S. retail sales is going to be weaker. Now, euro, I'm bullish euros. And the reason why I'm bullish euros is because the Fed is expected to be dovish and show a very strong commitment to additional easing this year. But the ECB, they cut interest rates last week. And then, they sounded a little bit non-committal to October easing. Ooh, I haven't shared my screen. Hold on. Let me, should we share my computer screen? 1 second. I don't know why it didn't change. My window. Okay. So now we have, what are we looking at? We are looking at how I'm dollar bearish, and you can see that I'm euro bullish. I'm euro bullish because, like I said, the ECB, they sounded non-committal, and U.S. yields have fallen a lot further than German yields have fallen. And mostly, this is going to be more of a function of dollar bearishness this week. But, because this ECB did not lay the groundwork for an aggressive easing cycle, the euro should benefit from dollar weakness this week. We also have a Bank of England rate decision. Now, I also built the Bank of England table to show you. And let me show you my Bank of England table. Give me a second to do that. My Bank of England table, I believe, is this one. So you will see here, this is a table showing how the Bank of UK economy changed since for the last meeting. And look at this. And I built these tables to make it easy to read. There's a lot more green than there's red, right? So there's a lot more improvements than deterioration in the UK economy since the last meeting. Retail sales is up. Labor market activity has improved. Inflation measures are mixed. So that's a little bit problematic for the central bank. But, and housing activity is a little mixed, but all the PMIs are better. Manufacturing PMI, services PMI, composite PMI, they are all in expansionary territory. So all the PMIs are better, retail sales is better, stocks are good, yields are down. Bank of England is not expected to cut interest rates this month. And for all of these reasons that you see here, that the economy is doing a lot better than than the previous month. And so that is why I am bullish sterling. Now, with that said, though, even though that may be the case, I think it's important to realize that the BOE is still expected to cut interest rates this year. So what the market will be looking for, the market does not expect any rate cut from the Bank of England, which is why I'm bullish pounds, particularly against the US dollar, and even in some ways against the euro. There could be guidance. They could be paving the way for an interest rate cut the following month. So be careful of that, because while I am pound bullish, they could lay the groundwork for an interest rate cut the following month. Now, Aussie. So UK has the BOE rate decision. We also have a ton of data, inflation, retail sales reports. And for the most part, those numbers are expected to be stronger as well. Then we have Australia. The RBA is one of the only central banks not expected to cut interest rates this year. They made it clear in their most recent policy meeting, and also when the most recent RBA governor spoke. They are not expected to lower interest rates this year. The most important report for Australia this week is going to be the jobs report. And we had, like the UK, stronger manufacturing services data, which tells us that, the Australian economy is doing well, and the jobs report should probably be stronger. And if that is the case, we should get, more Aussie strength than weakness. We also have, the Canadian dollar. With the Canadian dollar, I am bearish the Canadian dollar. Now, the Canadian dollar, which, if you look at the screen, we didn't really talk about this. It is the only currency here that is, let me show my daily chart, that is kind of flat. Every other currency is up against the US dollar. The Canadian dollar is flat. Why is the Canadian dollar flat today? The Canadian dollar is flat because, last week we had weaker jobs numbers, we had weaker IVPMI numbers. Also, the Bank of Canada, they cut interest rates, has more to come. Oil prices have been collapsing. So for all those reasons, I'm still bearish Canadian dollars. So I've been bearish for some time. It explains why dollar CAD has seen very little movement. This week, we don't have much. We have Canadian inflation data, which should reinforce the bearishness. And then I'm neutral to positive New Zealand dollars. We had Kiwi PMIs. They were stronger. This week, we have New Zealand GDP numbers. Now, GDP is backwards looking. The market doesn't really care all that much about it. So I think Kiwi is mostly going to move on the market's appetite for US dollars. So Kiwi, I'm bullish neutral because I'm bearish US dollars. Swiss franc, I'm neutral bullish as well. Nothing going on for Switzerland this week. So it's also going to trade on the market's appetite for US dollars. Now, the last central bank rate decision we have this week is Japan, the Bank of Japan rate decision. And I also built a table for the Bank of Japan rate decision. So let's go ahead and take a look at my table here for the Bank of Japan rate decision, which I think is this one right here. Nope, that's the US one. So the Bank of Japan one should be this one, I believe. Yes. So this is the Bank of Japan one. And you can see that, once again, what's more, there's a lot more green than there is red. Retail sales is mixed, but overall retail sales year over year is up nicely. Household spending is up. Employment conditions have improved. Earnings have improved. Consumer prices are down a little bit, which is not great, but Tokyo prices are up. And also, EcoWatcher survey is up. Tancan's down a little bit. The problem area is in housing market. Sorry, not housing market, but trade activity, industrial production, and some of the PMIs. So, that's a part that really matters. And so one of you are asking, Andrew is asking, will BOJ be very market moving? All eyes are on dollar yen right now. Well, timing matters, right, Andrew? Because we have the Federal Reserve meeting on Wednesday and the BOJ meeting on Friday. So yes, BOJ meeting will matter because, first of all, if it happens tonight, it won't matter. That's a really good question. It won't matter if it happens tonight. It won't matter if it happens tonight, because if it happens tonight, the market will look past it and say the most important thing is the Federal Reserve. But it's happening on Thursday night, Friday. Thursday night for me, Friday for Japan. So it will matter because the market will have already gone past the BOJ meeting. They would have already absorbed gone past the Federal Reserve meeting. they already have, reacted to the Federal Reserve meeting, and they'll be looking for this next catalyst. And the next catalyst is, will that yield gap between the US and Japan widen even further quickly? And they'll be looking at, and the BOJ is not expected to raise interest rates, although I would not rule out a surprise rate hike because they already told us that they want to raise interest rates. Even if they do not raise interest rates, they'll probably signal that a rate hike is coming. And so if the dollar sells off, if dollar yen sells off after the Bank of Japan rate decision, then and the BOJ comes in and they're hawkish, then yes, that could compound the move for the yen. So I think that all eyes are on the Fed this week, but because BOJ is happening after and not before the Fed meeting, it will be more market moving than usual. So that's basically the major events as well as the calendar, but there's a lot more on the calendar besides that. So if we take a look at the calendar itself, today we had Swiss producer prices, which came in. Here, let me disable my ad blocker here. Swiss producer prices came in lower, which is a bit bearish for the currency. And then look at all these ads. Okay. And then we had Eurozone trade data, which came in weaker, which contributed to the weakness in the euro. We had CAD data, which was a little bit weaker, a little bit better, which didn't seem to help CAD all that much. Empire State Manufacturing Survey from the U.S. came in stronger, led to a little bit of a bounce in dollar yen. Tonight, we have Chinese markets closed for the Mid-Autumn Festival. Overnight, we had Japanese markets closed, which is why we haven't seen too much action. And then tomorrow, we get the German zoo survey. The German zoo survey is expected to be softer because we had some really nice improvements. And then, now that the Olympics are behind us, we are seeing we could see a little bit of deterioration in the zoo survey. Canada has inflation numbers. And according to the IVPMI report, prices actually increased. So we may not see, I still think inflationary pressures are going to drop because the Bank of Canada is dovish. Oh, let me reshare my screen. So I realize it's not sharing my screen. Don't know why it keeps on doing this. Because I'm literally sharing my monitor, but let's keep going. So this is the calendar. So inflation will probably be a little softer in Canada, which I think will keep pressure on the Canadian dollar. But the main focus tomorrow is U.S. retail sales. What is going to happen with U.S. retail sales? We had lower gas prices. Red Book retail sales was weaker. Auto sales was weaker. So I do think retail sales are going to be softer. And that could lead to a little bit more weakness in the U.S. dollar going into Wednesday's FOMC rate decision. We also have industrial production, which really doesn't matter all that much. Actually, you know what? Probably Forex Factory would be a little cleaner because I think the font on this is a little bit too small. All right, so let's go to the rest of the week. And then on Wednesday, we have UK inflation data. And, both the manufacturing sector reported stronger prices, but the service sector reported weaker prices. Look at this. Core CPI growth is expected to grow from 3.3 to 3.5%. So there is a good chance that, sterling could maintain its gains going into the Bank of England meeting. Final Eurozone inflation data shouldn't matter at all. But the main focus will be, of course, on the Fed meeting. And that is where we went through all of the things that to look for, the dot plot, the economic projections. And please watch our YouTube video that I put on, the 4 ways to trade FOMC, because that will give you insight into how you should trade. We also have New Zealand GDP numbers. New Zealand GDP numbers are expected to turn negative in the second quarter, which would be quite weak. We did have weaker retail sales, so that could come out that way. Australian jobs report. Australian jobs report, it is also expected to be weaker, but we care much more about how full-time jobs are. And overall, even if it's weaker, the Australian labor market is still adding jobs at a decent pace, and it's showing strength in the PMIs. So I don't think it's going to be that bad, but we'll see. The UK has the Bank of England rate decision along with the inflation letter. That's going to be very important. Philly Fed will probably be stronger given today's strength and Empire State. Then on Thursday evening, Friday, we get that BOJ rate decision. No changes expected from the Bank of England, no changes expected from the Bank of Japan, but they both could signal moves the following month. But I would not rule out a surprise for the BOJ. And then on Friday, we have UK retail sales, Canadian retail sales numbers, and CAD retail sales will probably be weaker. UK retail sales are expected to be stronger. So there could be a nice divergence in pound CAD, for example. So not only do we have 3 central bank rate decisions this week, but we also have retail sales reports from many countries. We have inflation reports from many countries. So now let's take a look at the charts. Let's take a look at dollar yen. Dollar yen hit a fresh, we have to go to our monthly charts for support. Dollar yen hit a fresh July 2023 low. So where is support in dollar yen? How far could it fall on a technical basis? Well, let's take a look at our fib levels. So we know that we actually just dropped below an important fib here. We just dropped below the 23.6% fib. And let's see if we got a fib here too. Yeah, so no coincidence, and I'm going to remove this so it does not distract you. No coincidence that the next support level in dollar yen should be at first of all, it's at 140 is an important level, although this morning we pierced below it, went to 139.57. So that is now the new level to watch, 139.57. 139.57 is also pretty much, I would say the high from this candle here and this candle here. Maybe it's a little bit above that. But the main level to watch is this 38.2% fib at 137.80. 137.80 is the main level to watch for dollar yen. There's a little bit of support at 139.28, but we got today's low, 137.80 are the support levels in dollar yen. And, there's no reason to believe that this decline will ease, that this decline will let up in any way. Resistance is obviously closer. Resistance is at the former breakdown point, former support here at 142-ish. That's going to be resistance in dollar yen. Eurodollar. Eurodollar broke above some really important fib levels. We see that on this fib. This was the break back above the 23.6% fib here. And it's also broken above. Let me go to a slightly longer term chart. So let me remove that for you. We've also I guess maybe that was the main fib I wanted to show you, which is the 23.6% fib that we were just looking at. Even here, it's broken above there. So I was looking at many fibs this morning, and it's broken pretty much above all of the major fib levels. So the next resistance, so the point I want to make is that this is an important breakout for Eurodollar. The next resistance level is going to be this spike high here, the swing high, which coincides right with these lows here, 111.50. Eurodollar loves to gravitate to the 50s and the hundreds. If you ever, learn anything about round numbers. By the way, we're doing a day trading webinar, day trading tips on Wednesday night that includes some of these things I'm going to talk about. Some of the things to know about timing of the day, timing of the week, round numbers. Boris, please drop in that that link for the webinar. It's a free class on day trading. And so I definitely encourage you to come to that because I completely forgot about it. But yeah, Boris will drop in that link, which I just put into our Discord, Boris. And so we talk about round numbers and significant round numbers and swing highs, swing lows in day trading and the targets for those levels. And that's where Eurodollar will probably hit 111.50 because it loves to gravitate towards the round number. So I'm still bullish euros. Lots of reasons to believe that that's going to continue to move higher. Pound dollar also breaks out to the upside and there's no resistance in pound dollar to these swing highs here around 132.40. Still looks like it's going to power higher. Very, very nice breakout. Dollar Swiss, we've got support around 84 cents. Looks like it wants to slowly move towards that level. Aussie dollar also breaking out to the upside, but there's more resistance. 67.60 to 67, pretty much 67.60, 67.67 is the resistance. So that's not far from current levels. So I would certainly prefer going long euro and pound versus Aussie right now. Kiwi, it's also rallying, but it's not been able to go above the 20 SMA, which is my yellow line. So I don't like that. So I'd be a little bit more cautious about that. Dollar CAD is just consolidating. Remember I told you there's a lot of reasons why CAD is bearish, but today oil prices are up 2%. A lot of the other major currency pairs are down. If we look at the shorter term charts, we don't have much going on here yet. But if we drop below 135.80, if we drop below 135.80, and let me bring in my zip chart here. If we drop below 135.80, we would be in the zip sell zone and already turning a little negative. At that point, we could see a more significant decline down to the 135, down to this level here, 135.50 level. So, that's basically what I'm looking forward to. Now, gold has had a very nice run. This is obviously a record high. So I'll let Boris touch on, how much further gold could rise. But, at this point, you're going to have to use your fib extensions to chart out the movements in gold because we are already at a record high. I think we previously looked at, let's see if we can figure out where this is. And then I think maybe we'll try from here. Oops. Where's my fib extension? Okay. I don't think let's do this from here. I'll admit, I'm the first one to admit that I'm not great with these fib levels. Well, I think that, it's probably around 27.50 that is going to be the resistance level in gold. But I think that we could have a little bit of a pullback. It still looks like it could pull back to maybe 25.35 before you get another leg higher in gold. So a lot going on in the markets, there's a lot to keep updated. I invite you to continue to join us on our live streams. We've got a day trading class on Wednesday night. Please join us in a day trading class. We're going to share with you tips to day trade the markets. We'll probably talk a little bit about post FOMC because it's going to be after the rate decision. Also, if you want to learn more about trading fundamentals, because clearly fundamentals matter, please, take a look at my Learn How to Trade Fundamentals course. It's a really good resource. And, now let Boris share his thoughts on gold and the indices. I'll also take a look to see whether there's any questions that you may have. And make sure you watch that video on how to trade FOMC because it's very valuable and it helps you really not trade as impulsively as, I think many of us are tempted to. So, and please stay on because we're going to roll straight into live trading with Boris. So Boris, you want to come online, say hi, and share what your
Hey guys, good morning. I'm sharing my screen. So couple of things. Good morning, everybody. Hope everybody's having a great start of the week. We have a very, very exciting week scheduled. We're going to live trade today. We're going to live trade tomorrow. We're going to live trade Wednesday for the FOMC meeting, and we'll probably live trade Thursday post FOMC. So I think there's going to be a tremendous amount of vol, a lot of interesting possibilities. So, unfortunately, I have only half an hour to trade with you today, guys, because I'm having internet issues, as some of you may have noticed. So I'm now running on my secondary internet connection. Today, I have a technician coming in to try to fix my internet at 10 o'clock. So if he comes in, we're going to have to, cut the feed, but we'll go until he gets here. The key thing that I really want to talk to you about is I did a lot of thinking over the weekend in terms of the tactics of the scalp trading that we've been doing. And I'm going to talk to you a little bit about 2 ways that we could scalp using the techniques that I have here in just a bit. But before we kind of start, Kay wanted me to talk a little bit about gold and anything else that's on your mind. So
there's some questions about silver, which is probably sharing a similar trend as gold. So maybe you want to look at that chart really quickly.
Okay. So let's first take a look at gold, because we'll go to the full chart, and I'm going to go. Let's just go to like a sort of a 4-hour chart. As you guys know, I've been super bullish gold for a very, very long time. Gold to me is just kind of a buy to dip trade all the way through. On the future side, one of the last thing, very important thing, by the way, we are rolling today towards the December expiry, the Z expiry. I'll go back to the charts and I'll show you how to roll that over. But just remember, we're not going to be trading the December contract. The September contract expires this Thursday, so everybody's rolling forward on Monday. That's the convention in futures. Just to let you guys know, move all your charts to Zs and start trading the Z contract, not the U contract, because it's going to be expiring on Thursday. For those of you who are trading CFDs, doesn't matter. CFDs are perpetual. Anyways, back to gold. Gold fresh session highs, going through the roof. I think, technically and fundamentally, the underlying strength of gold is basically addressing one thing that neither candidate addressed, which is the ballooning budget deficits, right? I think when you think about the one certainty in the U.S. Economy is that the U.S. federal budget is going to continue to expand regardless of whether Trump comes into the office or Harris, because both of them, one will simply cut taxes, which was going to create a bigger hole in the budget. The other one is going to increase spending, which will do the same thing. And what I think gold is really experiencing as far as a move here is a fear that the bond market will eventually buckle under all of this deficit financing stress. The Fed is going to have to step in, and if the Fed tries to monetize a lot of it, I think the bond market may begin to rebel. So I think gold is an early warning signal of sovereign debt crisis that may be brewing, regardless of who is going to be the president. And I think that's probably one of the most interesting tells as we kind of enter into the election season. Now, what does that mean as far as technicals and where we go? We go up until we stop going up, right? I think I've been long term. I think gold has every possibility to go to 5,000. In other words, we could be in the next major super cycle, and when we have these big super cycles, gold usually kind of quintuples off of its bottoms, right? It goes 5x before it sort of exhausts itself in order to create the purchasing parity between gold and financial assets. So long term, I just think gold is the new BTFD, buy the freaking dip trade. On the short term, yes, we're growing. We're a little bit overbought. We've clearly had a very, very nice big move over here, but we're still holding the bid. We're still holding the short term moving averages on the 4-hour chart. There really is nothing here that makes you want to certainly go short this thing. You may be cautious in terms of buying the longs, but it's impossible to see to know how long this is going to expand in the near term. All we know is that we know what are the underlying forces that are driving gold, which is sovereign debt problems, and that is always, by the way, what underlies gold. People always think gold is a trade on interest rates and inflation and all of that. It really isn't. Gold is always a purchasing power protection. It's the fear that the sovereign debt market begins to break. Until that really happens, we're not going to have these parabolic moves. But what the market is clearly pricing is the possibility of that happening. Silver, is its sort of secondary cousin. So nothing else is going to drive these forces quite the way like sovereign debt concerns. You can talk about demand, you can talk about supply. It basically becomes a churn trade up and down until the mentality really shifts. And what you're seeing right now is a pretty significant fact of market mentality shifting against sovereign debt financing, which is becoming unsustainable. I mean, we all know the numbers. We all know that right now we're at a point where interest rate coverage. That means the money that the federal government is spending just to pay off interest rates is actually exceeding all of its the defense budget, on an individual basis, Social Security payments, all those, the actual functioning of the government is being occluded or being overshadowed by the servicing of debt. Now, that's obviously an unsustainable situation. The Fed, it's one of the reasons, by the way, an argument for a 50 basis point cut and maybe, back to zero, because the only way you can kind of calm the waters on the sovereign debt crisis is to get rates to be zero so that the servicing of debt becomes very, very manageable. And then they can just pare down by letting the economy, grow slowly but surely, which is, I think probably the most interesting argument for an aggressive Fed cut. Everything else is nonsense. We all know the economy is fine at this point. Labor markets are pretty good. We may be a little bit, the general idea is that we should be about 125 basis points over nominal rates. We're probably about 325 basis points over nominal rates, meaning, over inflation. So if inflation is like 2.5, we should be at 3.5 real rates, and we're like at 5.25 real rates. So yes, there's definitely scope to cut it down, but there's a much greater reason to cut it down is just to get the financing costs for the federal government to be lower. So that's sort of, my macro riff on all of this. We'll talk a little bit more about all of that in our day trading webinar, which is coming up this Wednesday. So come join us, because it's really, I think you're going to find it really, really interesting. In the meantime, let's look at, let me go back to the 1 minute chart, and let's go back to what's going on. And I want to just position you, and we'll talk a lot more about this tomorrow when hopefully we have a little bit more time, into understanding some of the cool, interesting scalping techniques that I'm able to do with my scalper 1.40. Those of you who are in my room, it's been upgraded to 1.40. Those of you who want to get the scalper, all you have to do is just simply join us. I'm going to give you a discount link that you can join us for a month, and you'll get access to the scalper indicator. Feel free to do that. Or if you want to join me in my coaching, which is going to start next week, you're going to get that for 3 months if you get my coaching. So very, very useful tool. This is the Swiss Army knife of trading. And I'm going to show you 2 ways that I've been trading this over the last, tonight, Friday, and over the weekend. I kind of found a 3rd way that I think all of you are going to really, really find very useful. So, we talked about the idea last week. I talked to you about this. First of all, let me explain to you what this indicator is showing. This is a 1 minute chart. We're going to use the S&P just or we may as well use NASDAQ, because everybody loves NASDAQ, so we can look at NASDAQ as an example. So here's NASDAQ, right? It's actually a cleaner chart of NASDAQ. This is a 1 minute chart. The green zones is when the NASDAQ is above the 8-period SMA. The red zones is when it's down. It's uptrend when it's in green zone. It's downtrend when it's in red zone, right? Very, very simple. That's all you really need to do, right? Need to know. The dark green, intensely green circles tells you that it's the beginning of it's a momentum trade signal, meaning that, it's a breakout signal. The bright green diamond is a retrace signal. So they're both positive trades. Greens obviously are the positive trades. Conversely, the dark red is a momentum sell, and a pink is a retrace sell signal, right? So we talked about last week, and we did a lot of these trades where we're looking for like kind of a double confirmation. We're looking for 2 signals within a trend slice. A trend slice is when the price remains either in green or red territory, right? So it would take the second signal, and try to trade it with like a very, very negative 1-to-4 risk-reward ratio. And I kind of left you guys hanging, trying to explain to you how I would resolve these trades if they went against me. So let's modify this approach. This is by far the most aggressive approach, and I don't recommend, unless you are a degenerate like half the guys in my room, of using this approach. But this is the kind of degenerate trading approach. First and foremost, we trade this with 2 accounts. So if you look at my, let me show you. Sorry, I'm having an issue with, here we go. Okay. So this is my TradeOvate account, and I have 2 accounts. One is a short account. This is my short account, meaning I only take short trades in this account, and 49 account. And one is my long account. Both accounts, by the way, significantly up since I left you guys because I've been trading the strategy really well. Now, let me show you how the strategy would work. Before I was saying to you, okay, we're going to use two signals to confirm our entry. Now we're going to get a lot more aggressive. The first signal, whether it be retrace or breakout within a trend slice, we're going to take that trade. We're going to go 1 to 4. In other words, if it's a sell, we're going to sell it with a 1-point target, 4-point stop in the S&P, or and this is the other thing that's interesting, on the NASDAQ, I've actually changed the ratios to just 3 NASDAQ points, 12-point stop, because NASDAQ at 520 was actually too volatile and too, stopping me out. You want to make it's just a quick. I want to make quick money, right? Now, what happens if it doesn't work? What happens if I get stopped out? Well, the second level of trade now is to increase my size just to twice, not to 4 times, but to twice. And what that will do is, if I resolve that on the second resolution, I'm going to be -2 on the overall position, right? So every time I'm making a positive scalp, it's +1, and assume I'm going to make 20 to 30 positive scalps a day. So it's plus 20, plus 30. But in order for me to recover my loss on the first move, it's going to be actually -2, right? Now, what happens in the absolute worst case scenario if that doesn't work? The second attempt at my trade doesn't work. When I go one more attempt at 10 size, okay, so I start with 1 unit, 2 units, third time is 10 units. This is all whether on a $250,000 account, I'm trading a one contract. So my maximum size is going to be 10 contracts. And if that gets resolved, again, it's the same thing. It's a -2 on the overall position. So let's say I'm +10 for the rest of for the beginning of the day, and then I get -2. That's how it works. And if it doesn't work, then that becomes like a -20. And it takes me probably about 2 days to resolve that. It's a nice stop. I don't do anymore. Now, this is a very, very aggressive, what I call degenerate way of trading, right? Now, the second way of trading that many of you are going to really love, and it's very, very interesting, and there's a sort of a really unique aspect to it, is we're going to look for longer term trend movements. First of all, we're only going to trade one size, just one contract, no doubling up, no going tens, no aggressively moving into the move. What we're looking for, and this is where it gets really, really interesting. I wish I could show you some examples today, but it's been a very, very choppy day so far. I'll show you some examples from Friday. Maybe, actually, let me show you. It's much easier for me to show you the examples on Friday so you guys can see how this works. I'm going to go backwards. This is NASDAQ, right? And let's go to a Friday trade. And the moment I show it to you, you guys are really going to understand exactly what I'm doing. So I'm going to go to, okay, here we go. So when we're looking for a swing scalp, sort of a more longitudinal scalp, we were looking for this kind of trend slice where it's about half an hour of continuous selling or half an hour of continuous buying. If we have half an hour of continuous selling, continuous buying, we are assured of making money in this particular trade in the way that I've set this up. So the way we're looking for this is the first component is we need some duration of selling. And we establish that by saying to ourselves, we need 3 signals, not 1, not 2, but 3 consecutive signals within a red zone, 3 consecutive signals within a green zone to give us a signal. So in this particular case, I'm going to go short after this third signal completes. It's a 774 close on NASDAQ, right? The trade is 20 points target, 40 point stop. It's a 1 to 2 risk reward ratio, right? Now this is where it gets super interesting. So, I'm short here, boom, plus 20, nice clean trade, I'm done, right? However, let's take a look at a situation where I have 3 consecutive greens over here, right? I'm long 803, right? And I'm looking for 823 as my target. I don't get it. I don't get the full 20 points, right? What do I do to manage this kind of a trade? And this is where it gets fascinating. There's 2 things you can do. First and foremost, and this is really, really important, the moment the trade goes into the opposite zone. So I started the green zone, I started a positive trend, and it goes into a negative trend. I don't care. I do not care about anything else but the fact that trend has been violated. It can go up 1,000 points after that. That's not the trade. The trade is once a trend has been violated, you go defensive. Now, if I happen to come in here at 802 and it closes here red at 804, I'm out at a small profit. However, and this is where it's really, really cool, because most people, okay, let's do this. I want to show this to you. Okay, so here's a good example of what I mean. I have 3 red candles, right? It looks like it's going to be kind of a long extended red zone, but it isn't. It isn't, right? It actually now turns green on me on the next candle. I've sold my position at 757. It goes up against me into the green zone, right? But now I'm negative. What do I do? And this is, I think, the most interesting thing about this trade, because I've back tested this and it works like a charm. Instead of trying to be stubborn, holding on to my position, yes, I would have made money on this. I would have been lucky and I would have made plus 20, right? What I do the moment the trend goes against me is I instantaneously go to my take profit at break even stop. So if I sold 757, it goes to like 65 into a green zone. I now buy back at 757. I don't care that it would have gone down. I cover my tracks, because what you will find in the market is that there are 3 ways to trade. And everybody always thinks about only 2 ways of trading, which is win or lose. But there is a very, very important component for professional traders that is more valuable than winning or losing, which is scratching your trades. The more negative trades you can get to break even, the less of a net negative impact you will have. Or to put it differently, you'll be able to save so much money that it'll actually become incredibly, net positive for you. So when you are in a situation like it going negative trend against you, you simply go to break even position. Unless you are already net positive, you just simply go out market. You simply go to net break even. You'll be amazed at how many times the market lets you out of what essentially could be a negative trade at break even. And you have a whole bunch of non-losing trades, which makes it so much better, because when the winning trades will always go to target, right? The winning trades just have enough momentum in there to always take you to target. So the key thing to worry about is how do you manage those mediocre trades and how do you manage the losing trades? And that is a super interesting structure that we're going to be trading this whole week. I think you guys are going to find it very, very useful in terms of our positions. Along with, of course, all the degenerate trades that we have going. So, like, just to give you an example, we can do this now, and assuming my technician isn't going to bother me. I'm just keeping this eye. We can take this trade. We're going to do this trade into my long account. This is a 3 green dot trade, right? So we got 32 seconds left here. Nasdaq starting to really move nicely. Maybe it's opening up a nice big trending move. So I'm going to go over here into my long account. This is my long account. I'm going to go into Nasdaq. It's a Z condition, and I'm going to go into 20 points, 40 points. I'm waiting for the candle to complete 9, 9, 10. So we're going to go. Okay, buy more. All right, I'm in with a 3 dot entry. 1, 2, 3. Right. I have a 40-point stop. I have a 20-point target, which means that my limit is 694, right? Now, we're going to watch this, and as long as it stays green, we're going to stay in the trade, right? If it turns red zone negative, then we're going to start managing it. That's really what we're going to be doing here on the swing trade. The degens just entered the room. Thank you. Okay. Now we're happy to do the degen trade. Is always the first circle, the first diamond off the zone, right? So in this case, the degen trade would have been this one. It would have been a nice, easy scalp. I didn't want to do this because I wanted to take the time to explain to you the longer term trades. And I'm actually going to see if I could write out the rules and then be able to post those rules, in the room every time I'm trading as kind of a explanatory structure, so you guys can take screenshots of it or stuff like that and understand it. So now we're still we're basically keeping the green zone floating. We're trading nicely. The The similar situation is in the S&P as well. So if you look at the S&P right now, it's a 1, 2, 3 zone S&P. And we can do the exact same thing in the S&P. We actually have a little bit better entries here on the S&P. So we're going to say buy market over here. I want to make sure, no, I'm going to be 4 points. Now, what we're doing in the S&P, look at this. What happened to my S&P? Did I make money already in my thing? Wow, I think I made money in my NASDAQ. I was so fast on NASDAQ. Yeah, we made money on the NASDAQ. So this was a very good example of why, this trade might really appeal to you guys. The NASDAQ trade just made $400 for us, right? It was a 20-point move, right? The S&P one, I bought a little bit late. I was just trying to do a million different things. But let's watch the S&P trade. I'm actually curious. Maybe the S&P trade goes to target. It's at 41 is the target, right? For us. I bought the U trade. Oh, Jesus Christ. I'm sorry. You know what? I got to get out of here. Shit. I bought the U trade. How can I S&P ESU? I thought I got rid of all my. All right, I'm just going to exit this out. I'm going to get out of the U trade. I want to get rid of all the U trades, which is the September zones. I want to go in here. Here's ESZ. Let's just buy bid over here. Okay, just for argument's sake. Oh, this is great. Now, what you're watching over here is me going into the red zone, right? Me going to the red zone. So, let's just imagine if this stays in the red zone, like this, it's got to complete the candle. And now I'm going to go into my defense mode, protective mode trade. I just wanted to show this to you. I'm hoping this goes into the defense mode because I really want to show you this structure. I want to show you the scratch trade, not the win trade. The win trade we already did. I want to show you the scratch trade. So I'm waiting for this. This has to end in the red zone. If it stays in the green zone, we just simply stay long the S&P. But if this goes into the red zone, all right, cool. So it stays in the red zone. So what I want to do now is I'm going to literally move my and now I'm at scratch, right? Now you're going to say, well, it's like kissing your sister. You scratched out the trade, but you have no idea whether this is going to go higher or lower. And if it goes lower, I'm -8, right? I'm -8. Now what I've done is I've avoided being -8. It's the same, a penny saved is a penny earned. Ben Franklin, one of the greatest traders in the world. It is awesome to not fucking lose money. It's better than winning money. And if you do that, and you see, by the way, how the market gave you a tiny bit of opportunity to get out flat, and now it may just simply, blow down the things. Having that incredible discipline, along with the fact that the indicator tells you exactly when to go to break even. I love the fact the indicator tells you exactly when to go to break even because it tells you visually that you're on the wrong side of the market right away, and then you simply go defensive. You go defensive, and you correct yourself. Yes, the moment. So Hawkeye is asking me to, trying to clarify the situation. Guys, am I like? I'm looking at my own feed here. It looks like I'm really, really far behind here. So the key thing here with the discipline of break even is if it breaks the trend slice, and in this case, the trend slice is broken because it goes from green to red, right? Doesn't matter that it's going to soar higher. The true good quality momentum trade, as we saw in the NASDAQ, stays in trade, right? In other words, if it's gonna be a momentum trade, it's gonna be green. You hit it over here, boom, you made target, you're done, right? That's the only trade we want to be in. All of the trades we want to be either scratch or hopefully, or unfortunately get stopped out. So by having that approach, by saying I'm only going to stay in a trend trade as long as the price stays in trend. I'm not going to hope, pray, wish, desire, and in any way, shape, or form change the reality that's in front of me. This forces you to accept the reality that is in front of you in the best possible way. Best possible way. It bitch slaps you out of dumbass trades. And I love that as a setup. So we're gonna do this every day this week. You guys gonna come hang out with me. I'm gonna show you a lot of these examples. What you see as a result of this is win, scratch, 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 win, scratch, 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 maybe one loss, right? Whereas in the other situation, what you see is win, win, loss, win, win, loss, win, win, loss, loss, and those losses are 2 to 1. They have to be wide. They have to be wide in order to give you a chance to recover. And the more wide losses you have, the worse the P&L becomes. This is a way to essentially truncate all of those wide losses, right? Is that clear to everybody? Are you guys sort of following me on the on my insane trip of trading here? So a little bit of we have a little bit of scalp going on over here, a little bit of degenerate trade in the S&P. Where am I? 8 seconds left. First signal, right? First signal. Sell market. Let me make sure I'm on the right side. Why is this not working? All right, Jesus. Nothing is working really well. Okay, so I'm short market. My TP is 90.75. Oh, yeah. Whoa, what the hell? Wait. Oh, I'm on the wrong. Oh, okay. Now I got to exit out. Exit out. Sorry, I had my S&P at the non-scalp position. It was on the ring. It would have worked on a really, really good move. Wow, that was a good trade. Big move. I made extra money on these general trades because I had the wrong structure on here. I had the 4-8 instead of a 1-4 structure. I'll get used to it. New month, new structure. By the way, you see I'm trying to keep the execution platform and the charting platform on the same charts. It makes it really, really easy for you guys. But a lot of I have to get used to all of this stuff. It's going to be tons of errors as we get going. Fortunately, the errors going our way. But that was a nice clean degen trade right here. Boom, boom. Single trade. You guys saw that, right? You guys clipped it. What else? What else can I tell you? Sorry, I'm just keeping my eye on the keeping an eye on my messages here because I'm waiting for somebody to come in. I am literally have not 1, not 2, but now 3 internet connections. I Verizon came into my building. I'm finally going to get Verizon, which I can't wait because I fucking hate my cable modem provider. But now I'm just sitting on T-Mobile Mobile because connectivity has just been a problem, and that's why I've been having issues trading. So I'll be able to set up. I'll be 3-way set up just like I am in Jersey. There'll be no technical issues going forward. What would be awesome, Brad? Awesome to what? What's awesome? What other questions do you guys have for me? Here, I'm just watching you guys chat to me. Oh, the set of learning rules. Yes. I think it's going to be super easy. I need to talk to my producer because I think there's a way we could actually superimpose those rules. How we have the superimposition here. So I could probably superimpose those rules on you guys for a description, and that would be very, very cool. I'm going to see if she can create one for me. It's really very simple. 3 dots, one way or the other. You go along with it with a 1 to 2 risk reward ratio, 20 points on NASDAQ, 4 points on the S&P. The moment the thing goes against you, you go to break even. If it stays green in your direction, or if it stays red in your direction, you ride it to profit. Now, what's cool about this, by the way, is there are at least 3 to maybe 6 trend slices a day that occur. In other words, where it goes for half an hour of continuous movement one way or direction, where we're assured of profit in the trade. Today we saw the first trend slice in the Nasdaq at the beginning of the day. One of the reasons why it's going to be cool for us, when we're trading longer time frame, longer time horizon in terms of the sessions being longer, we'll hopefully be able to catch maybe 1 or 2 of these half-hour signals. Because it's really, if you think about this, it's price against across time. The longer the trend stays in place, the higher our probability of hitting that long scalp trade. But we're trading the 1-minute chart, so it's very sensitive to any kind of a adverse movement. A lot of times that adverse movement just spooks you out. But I'd rather be spooked out of a potentially profitable trade than to be able to hold on to a definitively losing trade. I can always come back. The beautiful thing is, even if you get spooked out, it's going to give you another three dot entry, and you can come back on the next trend slice. Remember, every trend slice is a fresh opportunity to make money or get the fuck out once it turns against you. That's the beauty of this kind of approach. And the coolest thing is the indicator 100% tells you objectively whether you're right or wrong, right? What you should be doing. Not whether you're right or wrong, but what you should be doing. It's super, super easy to act because there's nothing interpretive here. That's what I love about it. Yeah, we changed to 1.4. What's changed between 1.4? I made the dots prettier, Karen. I made the dots prettier. I made the retraces diamonds. I made them light green. I made the dots dark green. I made the pink dots. I made the red dots. That's what it is. It's pretty little dots. The actual logic has not changed at all. It's all it's all the same logic. I haven't changed the execution engine at all. But I'm playing with dots now. That's my new hobby. Is making dots pretty. So I made the dots pretty. I think I'm done with the dots. I think they're pretty much it on the whole situation. So hopefully you guys will really enjoy it. This is a 1-minute chart. How accurate? It's not accurate. The more sensitive you are to time conditions, we're trading. Remember, the game plan here is scalping, my friend, right? You can do this on 1-hour charts, and you could absolutely do this on sort of like longer term positions. I actually looked at it, and you could trade like Nasdaq could be traded at 100-point target, 200-point stop, like really, really big ass trades on 15-minute charts. But that's not what we do. We're here to make trades every single day, lots and lots of trades, and control our P&L to a very, very. As a matter of fact, guys, I'm gonna have a scalping video coming out on the YouTube channel probably next week that I'm working on right now that will help you understand why I really, really like scalping. This 3 dot entry is much more amenable to those of you guys who don't want to degen trade every 5 minutes. Because as you can see, it's not like it shows up all the time. You have to build a trend condition. And usually it's like maybe 1 or 2 signals in an hour. And if you just watch it for a couple of hours, you really can catch 1 or 2 of those moves. But if you want to go on the longer term charts, absolutely, there's opportunities. You have to obviously expand your stops, expand your targets, look for kind of a deeper setup. But the whole principle, if you want to be in trend, it better stay the fucking trend, is gold, whether it's on a 1-minute chart or in a 50-minute chart or an hour chart. That's what makes the indicator so really, really cool. All right, I got another red dot sell. Now, am I in the Z zone? Yes, I am in the Z zone. How much time do I have left? 35 seconds. I haven't even been able to put the all the indicators on my new thing here. But let's see. I'm gonna do. Nope, it disappeared. The signal is kind of disappearing, playing around with me. And remember, if it's to the top of the chart, I'm at the top of the candle, I'm not going to be playing with a signal. So not much degen. Actually, if you look at NAS, let's have fun with NAS. Oh, can I do NAS? Oh, shit. Nah. Okay. Buy bid. I'm in the wrong one. Am I in the wrong? Oh, exit. Fuck. I'm in the wrong one. Exit. Okay, shit. I'm sorry. I'm doing everything manually because I have everything set up wrong. Okay, let me do this correctly. All right. So the NASDAQ trade should have been 3 points, 12 points, right? Which I bought over here. This was the entry on the NASDAQ trade. I bought it here 75. The cool thing about the 3 point thing is it just clips it really, really fast on a trade. So if I came in here at 77, the high was 82, which is more than 3 points. That's the whole thing. 3 you can make on NASDAQ pretty easily, but trying to go for 5, you miss the 5, you're minus 20. This is what I figured out. NASDAQ really, really fucks you if you don't take the quick trade. The S&P is a lot more forgiving on a 1 to 4 basis. So if you want to trade NASDAQ, you got to be just completely heartless on a 3 point move. But 3 point move, that's not a bad move. It's a $60 move every couple of minutes. As you can see, it adds up. I was in the wrong account. I put it into my short account. But my long account now is well above. I was at 55 with you guys. Now I'm at 56.4. My short account was at around 50. Oh, there comes my my guy. Okay, guys, I'm sorry. I have to go. I'll be right back. All right, it's a typical clusterfuck Monday. I'm sorry, guys. I will see everybody tomorrow when everything is going to be nice and easy, and we will have a new session. I'll see everybody later. Take care.